Okay, so welcome back everyone. Question number 13 onwards we are going to discuss in this lecture. 1 to 12 has been over in the previous one and it was quite interesting. So question number 13 onwards we are going to look at some more concepts, and we are going to continue on the target of calculating the value of the company. That is all about the corporate valuation and this chapter that we are discussing. Question number 13 in front of you. Let's have a look. Using the chop shop approach or the breakup value approach. Now you might be thinking that before starting this question, I think we should discuss about the concept of chop shop approach or the breakup value approach, and let me give you a hint about that. Chop shop, chop. Chopping means cutting down or separating a part of something. Okay, so what is given in the question is we have to calculate the value of a company based on three different bases, or we can say instruments, sales, and assets and operating income. These are the three things given in this question, and every category has their own values to form the value of the company itself. So chop shop approach in itself is nothing but calculating the value according to every approach, combining them, and then doing the average. Once you will complete the question, you will realize that this concept is very easy. There are no formulas in this. Have a look. Using the chop shop approach or the breakup value approach, we have to calculate the value of Cornet GmbH, whose stock is currently trading at the total market price of 4 million euros. So this is the current market value of the company, 4 million. And still we have to calculate the value of this company according to this method. Okay, for Cornet, the accounting data set forth in the three business segments: consumer wholesaling, specialty services, and assorted centers. Data for the firm's three segments are as follows. See, there are three business segments: consumer wholesaling, specialty services, assorted centers. And for all these segments, what are the sales, assets, and income? All the three parts are given to you. The sales of wholesale business, specialty services, and assorted centers, the assets involved in that, and the total income of every segment. Okay. Industry data for pure play firms. What do you mean by the pure play firms? Similar firms. It means firms just like us in the market, or we can say the competitors. So the industry average data for the similar firms have been compiled and summarized as follows. So it means we just have to analyze this now. Business segment consumer wholesaling, and the capitalization to sales ratio is 0.75. See, understand the formula. Capitalization divided by sales is 0.75. So if you have 1 rupee of the sales in your business, your company's value should be 0.75 rupees. That is what the meaning is. I will just explain that to you here. The formula is capitalization to sales, right? And if this is 0.75, you can say it can be like 10 to 7.5 rupees. Just a second. So if the capitalization is 10 rupees and the sales are 7.5, no, it's not like that. It's just the reverse of it. If this capitalization is 7.5 and the sales is 10, we can say 0.75 is this ratio. That means, what does that mean? 0.75 is the value of your company. 75 paise is the value of your company if your sales are rupees 1. For every 1 rupee of the sale, 0.75 is the value of the company. So basically what we are going to do, capitalization to sales is equal to 0.75. See, capitalization divided by sales is equal to 0.75, and you can put down the value of the sales, which is 1.5 million, and you can automatically calculate the capitalization value. So if I go by that method, what I'm going to do next here is I will just put down the value of sales, and the sales is 1.5 million, right? And if you keep it like this, you can easily calculate the value of capitalization as 1.5 million multiplied by 0.75. And in this manner, we are going to calculate 9 different values. Can you just imagine? We have 9 figures, 3 for the capitalization sales, 3 for the capitalization by assets, 3 for the capitalizations by operating income. We have the values of all these items. We can calculate 9 different values of the company. And then we can average out everything. Okay. So, so 9 means there will be 3 values of the company, 9 values including the segment as well. So if you want to calculate the value of consumer wholesaling, there will be 3 values based on 3 different bases. Specialty services and assorted center, 3 and 3. So have a look. What are we going to do? So we first started with this sales figure, and you can see we have taken the business segment. Okay, this is the capitalization to sales ratio, and this is the actual value of the sales, and then we have received the theoretical value. So according to sales, the value of consumer wholesaling segment is 1.125 million, value of specialty services is 8.88 million, and value of assorted center is 2 million. And combining all the 3 segments, the value of this Cornet GmbH is 4 million. And the second working will be based on the assets. Now it would mean if you have deployed 1 rupee of the asset in the company, then your company's value is 60 paisa. In specialty services, every rupee of asset in means that 0.90 or 90 paisa is your value of the segment. In assorted centers, every value of every rupee of assets includes or means that 60 paisa is the value of your segment, and accordingly you can calculate the value of the company. You can do the same with the operating income as well. Also, let's try to read that. 10 means every single rupee of income, operating income in consumer wholesaling, means the value of that segment is 10 rupees. For every 1 rupee of income, value will be 10. For every 1 rupee of income, value will be 7. For every 1 rupee of income, value will be 6. So just multiply it with the income. If 1 rupee of income gives me 10 rupee of the value, so 1 lakh will give me 10 lakh rupees. In this case, it's euros. Do you get that? It's a German company, so it will be euros. I was just saying rupees for like just making you things and like easily understandable. So this would mean 10 lakhs or 1 million. This is the value of that segment. So let's calculate now. We will, on a second part, we will just, there is one correction you need to do. It should be segment assets. This is segment capital to operating income and operating income. Please make that correction. I will do it in the next version. So this is capital to sales ratio. This is the capital to assets ratio. This is segment assets, and this is the value according to assets. So this is value according to assets. This is the company's value according to asset. According to operating income, this is the company's value. And the chop shop approach says that no matter how many segments are given or the basis are given, what you are going to do is calculate the value of the company according to each basis and then add up them, average it out. So what we did is average theoretical value. We took these values here, we took these values here and averaged it out, because there are only 3 segments, or we can say 3 bases given, like sales, assets and operating income. We are dividing it by 3. Otherwise, if there are 4 bases, we will divide it by 4. Simple average. So average theoretical value of the Cornet GmbH is coming to 4.178 million, whereas the market value is 4 million. So what is your conclusion according to this? According to this, your conclusion is the market value is underestimated, or we can say it is undervalued. You can buy the shares right now because you think that the real value of the market is of this company is 4.178, and if you can buy that share at 4 million, or we can say whatever the market price, it's undervalued. You should buy it. Now question number 14 is exactly similar to the question number 13. except for one fact, and that's what is interesting. See, again in this question, if you will realize, there are segment sales, there are segment assets, and there are segment operating income, right? All the three segments are given. Now, if you go with the industry data, the ratios are given like sales by capitalization, assets by capitalization, and operating income by capitalization. Now, this has made the difference. Sales by capitalization is equal to 1.18. Now, if you want to calculate the value of the company, you will have to shift this capitalization to other side. So it will look like sales by 1.18 is equal to capitalization. Do you understand how different it is from the previous question? In the previous question, the ratios were capitalization by sales. In this question, it is sales by capitalization. So instead of multiplying the sales with these figure, now we will have to divide the sales with the values 1.18. That's the only difference. A lot of students got confused that why this has been done, but they never paid attention to the type of ratio it has been given. In the previous question, it was capitalization by sales. It was like capitalization by sales, and in this question it is sales by capitalization, and that has made all the difference. So instead of multiplying as you did in the previous question, you are going to divide 2.25 million euros with 1.18. Do not multiply, divide it, because the formula is twisted. Or the other thing that you can do if you have to multiply is take the inverse of 1.18. You can take the inverse of 1.18 and then write down the values. That's around 0.847. That will result into some rounding of error. Now this value you can multiply because now you have inverted that, right? See, you can clearly see here what the question has done. 1 divided by 1.18. Now it is capital to sales. Earlier it was sales to capitalization. Sales to capitalization can be converted into 1 by capitalization to sales. You know, the bid and ask. The bid and ask, or direct to indirect quote. So it is like that. Now you can multiply 2.25 with 0.85. 2,25,000 with 0.85 can be multiplied. But otherwise you will have to divide it by 1.18. So it's up to you what you want to do. You can do it like this: 2,25,000 divided by 1.18 or 2,25,000 multiplied by 0.85. It will give you the same answer except for the rounding of error. Now rest of the things are same. You are going to calculate the market value based on the three different bases and then average it out to calculate the theoretical value. In this case, the theoretical value is less than 4 million euros. In this question also, the market value seems to be 4 million euros for this company. Let's have a look. See, this is the same question again with 4 million market value. Now what we have to do is, what will you call this theoretical market value? After comparing the theoretical market value with the current market value, you will say that the market is overvalued. This value of the share of this company is overvalued because it should be somewhere around 3.76 million, but it is trading in the market, the company is trading in the market at 4 million, which is overvalued. Do not buy it. So in this case, you will not buy it because the shares are overvalued. Oh shit. Just a second. So in this case, you will say it is overvalued. And in this case, it was undervalued. Right. Let's move on to the next question now. I hope you are comfortable with the chop shop approach now. Why I took both the questions is just to explain the difference between the first and the second question. A simple deviation in the numerator and denominator can change the method of solving the question. Now this is going to be an interesting part, question number 15. So before going to question number 15, let's have a look on the concept sheet. See, question number 13 and 14 were on the chop shop approach. We have completed with that. Now we are going to calculate the value of the firm using the Gordon's growth model, or we can say free cash flow model. Free cash flow model. So dividend model says that market value is equal to D0 in bracket 1 plus growth divided by cost of equity minus growth. But what does the free cash flow model says? That free cash flow is nothing but 1 plus growth, free cash flow at the time of 0 to equity divided by cost of equity minus growth. And if you want to calculate the value of equity, you need to take free cash flow to equity. If you want to calculate value of the company entirely, this is free cash flow to firm, and then overall cost of capital. I will just show you, or we can say I will write it here itself. See, if you want to calculate the value of equity, or you want to calculate the value of the entire firm, how it differs? It will be free cash flow to equity 1 plus growth, cost of equity minus growth. Now in this case, free cash flow to firm 1 plus growth, overall cost of capital minus growth. So these are a couple of things, this firm, E and E. So these are a couple of things which you need to be very careful about. Have a look. Question number 15. A valuation done of an established company by a well-known analyst has estimated a value of 500 lakhs for the company based on the expected free cash flow. Just a second. For the next year. So this is free cash flow at the end of year 1, not 0. That means growth is included in that. The word next year itself explains this. The expected growth rate is 5%. While going through the valuation procedure, you found that the analyst has made the mistake of using the book value of debt and equity in his calculation. So what is this mistake? He, while calculating the overall cost of capital, while calculating the weighted average cost of capital, he took the book values of debt and equity instead of taking the market values. So if I put book values on one side and market values on one side of the equity and debt, which is more important and relevant? Market values are more important. So the question says that the weights should have been taken based on the market values and not the book values while calculating the WACC. And that's where they did wrong. While you do not know the book value weights, he used the following. You have been provided with the following information. See, company's cost of equity is 12% and the cost of debt is 6%. The market value of equity is 3 times the book value of equity, and while the market value of the debt is equal to the book value of the debt. So can I say market value of equity is equal to book, like this? Market value of equity is equal to 3 times the book value of equity, and market value of debt is exactly equal to the book value of debt. Now what happened? We took this book value of debt while calculating the WACC. Book value of equity while calculating the WACC instead of taking the 3 times of it, which is the market value. Okay. So if I just calculate it, it will be like 3 and 1, 3:1, 75-25 ratio, something like that. But let's see. You are required to estimate the correct value of the company. Have a look now. This is question number 15. So first we will go with the wrong values. Or better to say it's incorrect value. So what is the formula? Sir, market value is equal to free cash flow of the firm for the next year divided by overall cost of capital minus growth. because equity and debt both are involved. And this is not just the market value of equity, it's the market value of the company itself. And which is 500 crore. Free cash flow to firm is around 20 lakhs. 500 lakhs and 20 lakhs. Divided by, we don't know the overall cost of capital yet, but the growth rate was 5%, I think. Yes, but the growth rate is 5%. So with the help of this, we can calculate the overall cost of capital, which comes to somewhere around 20 by 500 plus 0.05. That's 9%. So this is the wrong cost of capital that we had calculated and used in the formula to arrive at 500 lakhs. So if we would have calculated the correct value of cost of capital now, this value would have been correct. Now let's go with the calculation of WACC. So how do we calculate the cost of capital? It's very easy, sir. Cost of equity into weight of equity plus cost of debt 1 minus tax into weight of debt. What is the cost of equity in this question? 12%. We don't know the weight of equity, right? So let's keep it that way. Plus cost of debt is 6%. There is no taxes. So 1 minus 0 is 1 multiplied by cost of debt is 6 into, can I write down this weight of debt as 1 minus weight of equity? Because there are only two things in this equation. If whatever will be the weight of equity, the weight of debt will be the balance weight, which is 1 minus weight of equity. And the overall cost of capital that we had calculated was 9%. So if we will start solving this equation, it will be 12 weight of equity plus 6 minus 6 weight of equity. Okay, so 12 minus 6, 9 minus 6 comes to 3, 12 minus 6 comes to 3 weight of equity. 12 minus 6 comes to 6 weight of equity. And the weight of equity will be 0.5, that is 50%. So what will be the weight of debt that we have used? That one also will be 50%. So these are the book values, right? What we have to do is we have to use the market value weights. So let's say, for example, I am just saying it like this. If the equity in the company is 12 crore in the balance sheet, the debt in the balance sheet is 12 crore. They took it like 12 divided by 24. That means the weight of equity is 0.5, weight of debt is 0.5. They went according to the book values, which was like this, 12 lakhs and 12 lakhs. Or 120 lakhs or 120 lakhs, any value you can take, but the ratio should be 0.5. This is what they did. Instead of taking the market value of the equity and debt, if you go by that law, market value comes to 12 into 3, because market value of the equity is 3 times. So it will go like this, 36, and market value of the debt is equal to the book value, and this is like 48. If you do this, the ratio will be 0.75 and 0.25. Now these are the correct weights. These are the market value weights. These were the book value weights. That's the mistake done by us while calculating the correct value of the company. So that was the wrong answer because the weights were wrong. This is the correct answer. So if you go by that law, you will get the weights as 0.75 and 0.25. How did we calculate 0.75? 3 times the book value weight. So let me just go ahead. If you take the market value weights, see, 0.50 into 3 times will give you 1.50, and 0.50 into 1 time will give you 0.50, and the total is 2. So if you calculate the weight, it comes to 75%. And this comes to 25%. Exactly. Now with these new weights, we are going to solve the equation. Now understand, We are going to put the new weights in this equation and calculate the new cost of capital. Then we are going to put this new cost of capital in this equation and calculate the new market value. That's it. The question is over. That will be the correct value of the company. Now coming over to the question. See, we used 500 lakhs, 20 lakhs is the free cash flow to firm divided by overall cost of capital minus growth. So when we used it, we got to know about the overall cost of capital is 9%. And now let X be the weight of debt, and then this, and then we reached at this point that 0.50 is the book value weight for equity and debt. So what will be the correct value? It should be 150% and 50%. So 0.5, 0.5. These are the book values. Multiplied by 3, multiplied by 1. Now this will be the market value. That will be 1.5 and 0.5. The total is 2. So if you will calculate it in percentage, it will be 75% and 25%. So put that again in the WACC formula, cost of capital. This is the WACC formula. Just a second. This is the WACC formula, correct value. Okay, now that will be 12% into 0.75, 6% into 0.25. The new cost of capital is 10.5% instead of 9. Instead of 9, it is 10.5%, and the correct firm's value will be 363.64. Simple and easy way. We just went backwards, found the correct value, and then went like this. Just a second. Now let's have a look on this new question. Question number 16. There is a privately held company, X Private Limited, that is operating into the retail space and is now scouting for angel investors. The details pertinent to valuing X Private Limited are as follows. So we have to first let's understand that this is a private limited company, and now this company wants to raise the funds from the angel investors. But before that, they want someone to value this company. The company has achieved a break even this year. Break even this year means they have now turned profitable. Till this point, they were like into losses only, and has a EBITDA of 90. The unleveraged beta based on the industry in which it operates is 1.8. This is beta unlevered. This is EBITDA of 90. Unlevered beta is 1.8, and the average debt to equity ratio is hovering at 40 to 60. See, unlevered beta means no debt in the company. If you have to include the debt in the company, then the beta will also change according to the debt equity ratio. Let's have a look. The rate of return provided by the risk-free liquid bond is 5%. The enterprise value is to be taken at a multiple of 5 on EBITDA. Enterprise value is to be taken at a multiple of 5 in EBITDA means 90 multiplied by enterprise value is equal to 90 multiplied by 5, that's 450, whatever the lakhs and whatever it is. Now the accountant has informed that the EBITDA of 90 includes an extraordinary gain of 10 for the year. So we have to reduce that EBITDA first. This will be the wrong figure then. Let me remove that. So this 90 includes the 10 lakhs or whatever it is of the extraordinary gain, and potential write-off of preliminary sales promotion cost of 20 are still pending. That means you have to reduce the 10 out of it, and which is already included in 90, plus also you have to reduce this preliminary sales promotion cost. The write-off of the same is still pending. Okay. The internal assessment of rate of market return for the industry is 11%. See, the market return is 11%, risk-free return is 5%. For this company, which includes the debt, you need levered or geared beta. We will say levered beta. So the beta given of 1.8 will be of no use to us unless we convert that unlevered beta into levered beta and then use it in the CAPM ratio to find out the cost of capital. So all in all, the maximum data given here is for the cost of capital, which requires CAPM, and in CAPM you need beta levered. Okay, the free cash flows for the next 3 years are as follows. The pre-tax cost of debt is 12%, tax regime is 30%. What is the potential value to be placed on X Private Limited? It's very simple, sir. If you go according to the free cash flows to firm, the market value of the company is nothing but free cash flows of the future year, first free cash flow of the second, free cash flow of the third year, and then discounted at the overall cost of capital. KO. But in order to calculate KO, you will have to use CAPM, and in CAPM you will need beta. Since this company or the industry includes debt, we need levered beta, and we will have to first calculate this levered beta from unlevered beta. So these are the things that you need to do. First, take the unlevered beta, use the geared ungeared beta formula, calculate the levered beta, use it in the CAPM with market return and risk-free rate of return, calculate the cost of capital, and then you can discount the other free cash flows. This is the another method of EBITDA. There is another way we can calculate the value of the company using the enterprise value, which is EBITDA into this. So all in all, market value of equity can also be taken. Let's see. So what I can say is what the question is asking us, calculate the potential value of this company. There are two ways to calculate the value of this company according to the data. First one is the enterprise value. Second is the discounted cash flow method. Enterprise value is very simple, sir. The EBITDA of 90 is given, which has to be adjusted with the extraordinary gain, that is 90 minus 10. Also, you will notice that some return of cost is still pending. Potential write-off of preliminary expenses is still pending, which is 20. So the new EBITDA will be 60. After that, the question says that the enterprise value is to be taken at a multiple of 5 on EBITDA. So if you take the multiple of 5 on EBITDA, it will be 300. So this is the first answer to this question, which is 300. And now in order to calculate the discounted cash flows, you will have to find out overall cost of capital. This overall cost of capital can be found by using CAPM. CAPM needs levered beta, and levered beta can be calculated using unlevered beta. So this is the chain. Let's write down. So we will have the cash flows. See, step by step. Year, cash flows, present value factor at some rate which we are going to calculate, and then present value. So 1, 2, 3. What are the three cash flows? 100, 120 and 150. 100, 120, 150. Now, in order to calculate the WACC, because these are the firm's cash flows, what we are going to assume, it will be cost of equity into weight of equity plus cost of debt 1 minus tax into weight of debt. Now understand, cost of equity can be calculated using the CAPM method. Weight of equity is 60% if I am right. See, the debt equity ratio is 40-60. That means 40 is the debt, 60 is the equity. Plus cost of debt. The pre-tax cost of debt is 12%. So 12 in bracket 1 minus 0.30 into weight of debt is 40%. Now what is pending is the cost of equity, which can be calculated using CAPM. So according to CAPM, if you want to calculate cost of equity, then risk-free rate of return plus beta of the levered company in bracket market return minus risk-free rate of return. You have gone through this concept. So what is the risk-free rate of return? 5%. We don't know the beta. 11 minus 5, if I am right. Yes. Market return is 11%. Risk-free return is 5. Now we need to calculate the levered beta, which is calculated according to the levered unlevered formula. Just a second. Oh God. Just give me a minute once again because it has crashed, and that's why I will have to write it once again. 100, 120, 150. So WACC. CAPM, cost of equity, market return, risk-free return. It's 5 plus 11 minus 5. Now coming over to levered beta, which is equal to unlevered beta into, if you remember the formula, 1 plus debt equity ratio in bracket 1 minus tax. It's very simple, sir. So unlevered beta is 1.8, 1 plus debt equity ratio point, or we can say 40 by 60, 1 minus 0.30. So if we do this calculation on the calculator, 40 by 60 into 0.70 plus 1 into 1.8, 1.8, yes, it will give us the levered beta is 2.64, a very high beta we can say. 40 by 60 into 0.7 plus 1 into 1.8, 2.64. Now you put this value of 2.64 levered beta here, that is 2.64. Now you will find out cost of equity. That's 20.84%. You can use this 20.84 in this formula, 20.84 into 0.60, that's 12.50 plus 3.36 of the debt. So total is coming to 15.86. So that's your cost of capital, which you will be using to discount this cash flows. 15.86%. Discount, take the present value factors and then calculate the present value. Do you understand the procedure? For the discounting rate, we need WACC. For WACC, we need cost of capital, cost of equity. Cost of equity can be calculated using levered unlevered formula. So this is the chain. Let's have a look if there is a variation in the answer that we have calculated. So 20.84, do you agree with this? 20.84 is the cost of equity, and this cost of equity is calculated using the levered unlevered formula first, which is 2.64. This is beta levered. Okay, once you put down this cost of equity here, you will get the final cost of capital. That will be the discount rate, which will be used here to calculate this value. This is so easy, na? Discounting factor multiplied by the cash flows and the total 272.15. If you go according to EBITDA, the EBITDA detail is this much, like enterprise value is 300. So this is the one value, this is the second value. Easy. Now coming over to question number 17. This is again going to be an interesting. What we are doing is we have used the enterprise value also. We have used the discounted cash flow also. Now if I will go to this concept part, you can see we have used the concept of enterprise value also. We have used the concept of discounted cash flow method as well. Okay. Free cash flow to firm. This is the free cash flow to firm. Let's come to the next question now. Question number 17. Mr. X is a financial analyst, intends to value the business. Again, what we have to do is calculate the value of the business in terms of the future cash generating capacity. He has projected the following after-tax cash flows. Year 1, 2, 3, 4, 5 cash flows are like this. Okay. It is further estimated that beyond 5th year, cash flows will perpetuate at a constant growth rate of 8% per annum. That means you will be calculating terminal value at the end of year 5 with the help of cash flow for year 5 into 1 plus growth divided by overall cost of capital minus growth. So this is a two-stage cash flow model where you are going to discount the first 5 years cash flow, exactly the same where we used to calculate the market price in security valuation. First 5 years dividend is discounted and then the terminal value is also discounted, just like that. Mainly on account of inflation, the perpetual cash flow is estimated to be 10,260 lakhs at the end of 5th year. So what you have to consider is not this, not 1170. You have to consider 10,260, which is already given in the question. So it's at the end of 5th year, 10,260. So understand, this is not the terminal value. This is not the calculated value. It is the perpetual cash flow which is going to grow. So this is just 10,260 in the numerator multiplied by 1 plus growth, that will be 8% divided by overall cost of capital that we are going to look into. Required. What is the value of the firms in terms of expected future cash flows if the cost of capital of the firm is 20%? How are you going to calculate? It's very simple, sir. Discount all these cash flows with 20% rate, present value factor, and then at the end of year 5, just at this point, calculate the terminal value using this formula, 10,260 into 1 plus growth divided by 20% overall cost of the firm minus growth of 8%. So it will be like this, 10,260 into 1.08 divided by 0.12, or we can say 0.20 minus 0.08, that is 0.12. So with this you will get the market value, terminal value, that comes to 92,340. Huge amount. The firm 92,340 again will be discounted at the present value because this is at the end of 5th year only. Let's have a look on the answer. See, first you will take the 20% discount rate, calculate the value of the first 5 years, okay, that is 3054, and then the calculation of terminal value, which will give you 92,340, and then when you will total this 92,340, this is at the end of 5th year, right? So you will take the present value of it at 4.402. This is the present value factor and this is the present value. So this is the present value of TV5, 37,120.68. Okay. So when you will add this 37,120 and 3054, you will get the value of the company, 40,175. Pretty much an easy question. Exactly similar questions has been discussed by us in the security valuation chapter. So don't be afraid of it. So this is the value of the firm. Now, the firm has outstanding debts of 3620 lakhs and cash and bank balance of 2710 lakhs. Calculate the shareholder value per share if the number of share outstanding is 151.50 lakhs. See, in this case, it was written we have to calculate the value of the firm. Now you need to understand few things. Value of the firm means debt plus equity both, calculated using free cash flows to firm and the discount rate of overall cost of capital. Okay, all the free cash flow to firm also includes debt plus equity, cost of capital also includes debt plus equity. When you deduct, there is one more way, or we can say, if we have to calculate value of the equity, which only includes equity, it can be calculated using free cash flows to equity and the discounting rate of cost of equity. So you understand the difference. Here it is overall cost, here it is equity, here it is firm, here it is equity only. And there is one more way to reach at the value of the firm, at the value of the equity from value of the firm. That's very easy. Just deduct value of debt. So if this is today's value for both, if you deduct today's value of debt, the balance will be value of equity. That's it, simple. If this includes both values and you deduct one, the balance value will be left for the other party. Now, if this is the value of equity, what are you going to do? You are going to divide it by number of shares to arrive at the market price per share. Am I right? Market price of one equity share can be calculated using the value of equity, not the firm. So what are you going to do? You are going to deduct 3620 lakhs from the value of the firm. And see, this is given, this cash balance is given just to misplace your understanding, just to confuse you. 2710 lakhs. This should not be deducted. This is a part of the value. And this is applicable for both, or we can say equity. This is the balance of the equity shareholder. You should not deduct it. So, the value that you have just calculated, see, value of the firm that you have just calculated minus the value of debt, this will become value of equity, and then divided by number of share, so that will be value per share. So I can write it like this: value of firm minus value of debt will give you value of equity divided by number of shares, and this is market price per share. So you can make a format like this: 4175.30 less 3620, that's 36,555.30. 151.50 is the number of share, and the market value is 241.29. Market price of the share is 241.29. Have you understood this? And do you get the logic of not deducting the cash balance? A lot of students started asking this query that why 3620, why the cash balance was not deducted. I was like, every information has to be adjusted, kya? No, not every information is to be adjusted. The relevant information should be adjusted. The rest can be ignored. The firm has received a takeover bid from XYZ Limited of 225 rupees per share. Is it a good offer? No, it's not a good offer. Someone wants to buy our company by paying 225 rupees for every share, where our market price is coming to 241. Someone should at least pay this much if they want us to get convinced for selling the company. My shares price is 241.29 and you are paying me 225 rupees. Takeover bid of 225 per share is not a good offer, as it is lesser than the calculated price by us, 241.29. Easy? Let's move on. So before starting this question number 18, I request you to come and discuss with me regarding the concept in the security valuation chart. So if you will open up the chart under that security valuation and come to the point where cash flow based is written, and you will see there are two things: free cash flow to firm and free cash flow to equity here, right? So we have discussed this in the security valuation chapter to calculate the value of equity share. Now on the basis of this, we are going to calculate the value of the firm. If the question asks you about calculation of value of the firm, you should do that on the basis of free cash flows to firm. If the question asks you about the value of the equity, you should do that on the basis of free cash flow to equity. So this is what you need to keep in mind. Okay, come over to this part. From this point onwards, for at least 10 questions now, if the question asks you about the value of the firm, understand that it should be calculated based on the free cash flow to firm, and discounting rate will be overall cost of capital. In short, if the value of the firm includes debt and equity, then the cash flow should also include the cash flows applicable for debt and equity, and the discounting rate should also include the discounting rate, weighted average discounting rate with cost of equity and debt. Simple. Now, the important part is this one, to calculate the free cash flows to firm. Once you calculate that, it's very easy to discount it, and even it's very easy to calculate this KO, WACC. But this is very important part. Free cash flows to firm means calculating the cash flows through which or out of which the amount becomes payable to these people. That means these cash flows should be calculated without taking into consideration any consideration that has been done to these people. If you have paid the interest, do not include that in free cash flow to firm, because we need to calculate that amount out of which interest will be payable. And if you deduct the interest already, that amount is no more payable, na? So it should be payable. Interest, principal repayment, such type of things. So this was the free cash flows to firm. Now, if you will see, there are multiple formulas or ways to calculate the free cash flows to firm, and all the answers, all the approaches will give you same answer. Okay, the most, or we can say the widely used format is this EBIT. This is the center of everything. Even if you start with EBITDA, you will have to reach at EBIT, then you can follow that formula. If you start with EAT or FCFE, we can reach at EBIT, and then we can start with the formula. So EBIT is an earning before interest and tax. So that makes us very clear that this is the earning applicable for debt holders, equity holders, and government. But we want the earnings or the cash flows only for debt and equity, right? We do not want the government in that. That's why immediately to start with, we will reduce the tax out of it. So EBIT 1 minus tax will ensure that the government is taken out of this figure. Now, the moment you do that, you will have to add the depreciation. Why you will add the depreciation? It's not just the depreciation. Any non-cash expense has to be added, or non-cash income has to be reduced. Why? Because we want to convert this earning into cash flow. That's why we are adding back the depreciation. Depreciation was already deducted out of this to calculate the tax benefit, but now it is the time to add it back. Okay, once you add back the depreciation, you have completed the working with the profit and loss account. Now the working with the balance sheet will start. And balance sheet constitute, see, I will show you. There are two things. This is profit and loss account, and this is balance sheet. Okay. If I ask you to calculate the free cash flows to firm, that means you have to reach at this stage. This particular box includes the capital structure of the company, that is equity, preference, debt, and everyone. So we have to reach at that point by taking the earnings from profit and loss account. So the very first thing that you will do from the profit and loss account is you will take the earnings, that is EBIT, not the net earning, EBIT, before deducting the interest. You will add back, you will deduct the tax out of it to remove the government out of the picture, and then you will add back the depreciation. Depreciation was a part of the profit and loss account, right? So once you add back the depreciation, you will convert it into cash flows, and then leave the profit and loss account and come to the balance sheet. And you will realize that balance sheet consists of fixed assets at this point, current assets and current liabilities at this point. So any expense in any cash flow in the fixed assets has to be considered, and the current assets and current liabilities has to be considered. So you have to adjust the capital expenditure. The outflow here will be the capex. That means if you purchase any kind of a fixed assets, that has to be reduced out of it. So this will be deducted again. And if there is an increase in the working capital, that means increase current assets minus current liabilities together. Take it together. So if there is an increase in the working capital, you will deduct it. If there is a reduction in the working capital, you will add it. So ultimately you will reach at this point. That means free cash flows to firm. Understand what type of things should not be deducted. Principal repayment will not be deducted out of these cash flows. Interest will not be deducted. So because these are the payments to the debt holders. Once you make the payment to the debt holders, the balance cash flow is no more applicable for the debt holders. So you need to stop the payments to the debt holders in order to show them the cash flow, that this is the cash flow out of which you will be paid. Okay. So that's the calculation. So EBIT 1 minus tax is going to be your major thing. You will add back the depreciation in order to calculate the cash flow. Plus comes the balance sheet items, that is capital expenditure to adjust the fixed assets, and less increase in the non-cash working capital. Increase in the non-cash working capital. This way you will really reach at the FCFF, which you can later on discount to calculate the value of firm. Even if you start with earning after tax, what you have to do is you have to first reach from earning after tax to EBIT. So what are you going to do with that? Earning after tax, you have taken it. You can add back the interest in that, but that too after tax, because we need EBIT 1 minus tax. So you can take the after tax interest and add it back to EAT. This entire figure will give you EBIT 1 minus tax. First of all, tax is already deducted out of this EAT. If you will add the interest, the tax portion will also come up with that. So we need to make sure that whatever we are adding to the EAT, because it is already after tax, the interest that we are adding back to the EAT should also be after tax. This will make the earning before tax into earning before interest but after tax. This is what? Earning before interest but after tax. And this is also earning before interest once you add the interest but after tax, because tax has been deducted. And then the same procedure, depreciation, capex, change in non-cash working capital. Remember that. This is how you can calculate the free cash flows to firm. Once you calculate that free cash flow to firm, what you can do is you can reduce the value of the debt out of it and you can reach at free cash flows to equity. It's very simple. And once you calculate the free cash flows to equity, see, understand, free cash flows to equity. Not this exactly, not this directly. Once you calculate the value of the firm through free cash flows to firm, then you can deduct debt out of it, not out of free cash flows. And then you will reach at, we can say value of the firm. Value of the firm minus debt is equal to value of the equity. Like this. If once you calculate the value of the firm, you can deduct the value of the debt to arrive at the value of the equity in order to calculate the market price of the equity share. See, this value of equity, understand, this value of equity can be calculated through two ways. First, you can take FCFF, discount all the cash flows with the overall cost of capital, and then calculate the value of the firm, deduct value of the debt, and then value of equity will be there. Or you can directly start with FCFE if the data is given like this, discount it with cost of equity, and you will arrive at this. So value of the equity has two different ways to calculate. Okay, understood? So this is what we are going to do. These two are the major parts, sir. Adding back the depreciation, reducing the capital expenditure, and then non-cash working capital. Okay, let's start with the first question now. Next 10 questions are going to be the important one in terms of, we can say, large questions. But later on, after 30, the size of the questions will be small. Following information is given in respect of, one more thing. Just to summarize everything, remember that value of the company today is nothing but the discounted value of the future cash flows. So if the company, see, 1, 2, 3, 4, 5, or we can say, let's say 1, 2, 3. If the company will have a certain cash flow for the next 3 years, and then the perpetuity will start. What will be the value here? Understand, what will be the value here? No matter if it is value of the firm or equity, if it is value of the firm, just understand, if this is value of the firm, you will need free cash flow of the firm at all the point and KO. If this is value of equity, you will need FCFE and KE. That's it. So how to calculate that? You will have to discount all the three cash flows first, and second you will have to calculate terminal value at the end of year 3 with the help of cash flow for fourth year divided by cost of capital minus growth, and again discounting it by third year factor. So value of a company at any point of time will be the present value of future cash flows for the first 3 years, and this TV3, that means terminal value, also includes the present value of the future cash flows at the end of year 3, and again discounting back. Okay sir, so most of the time this will happen. This will be high growth period and this will be stable growth period, perpetuity. Now let's read the question. Following information is given in respect of WXY Limited, which is expected to grow at a rate of 20% per annum for the next 3 years, after which the growth rate will stabilize at 8% per annum normal in perpetuity. Now understand. One, two, three, and then like this. So the growth rate in the first 3 years is 20%, and then 8%, right? So can we call it as a high growth period, the first 3 years, and then the stable growth period in perpetuity is 8%. So there will be only 3 cash flows or 4 values which will sum up to the value of the firm. First, the cash flow at the end of year 1, 2, 3, and then the terminal value at the end of year 3. And you know it very well that terminal value at the end of year 3 will be nothing but the cash flow for the next year, that is year 4, divided by cost of capital minus growth. Now understand few more things. If you have been asked to calculate the value of the firm, then all these cash flows will be the cash flows to firm, and this will be the overall cost of capital, KO. But if this is equity, then all the cash flows has to be related to equity, and this will be cost of equity, K. Okay, have a look. Now revenues for the current year, cost of goods sold, operating expenses, capital expenditure, and depreciation included in the cost of goods sold and operating expenses is 600 crore. See, this is the depreciation which is already included in one of the two. It is not required as such, okay? But this will be helpful to add back in the after tax profit. Just a second. Right? So you will start with the revenue. Just understand, revenue, cost of goods sold, operating expenses. Till this point you will get your EBIT. Right? EBIT. Let's have a look. During the high growth period, revenues and earnings before interest and tax will grow at 20% as it is said, and the capital expenditure net of depreciation will grow at a rate of 15%. Capex minus depreciation. You remember one thing. We started with EBIT 1 minus tax, and then we had to add back depreciation, deduct capex, deduct change in working capital, right? These are the 3 items that needs to be adjusted. And what the question is saying, capital expenditure net of depreciation. You can clearly see depreciation is being added, capital expenditure is being deducted. So let's say for example depreciation is 10 and the capital expenditure is 15. So practically speaking, even if I deduct 5 out of EBIT 1 minus tax, still it will give both the adjustments. Like I can say that both the adjustment has already been given in reducing 5. 15 minus 10 is already 5. So what is the capital expenditure net of depreciation? 5. So if I'm considering only 5, that means I'm adding back the depreciation already, right? Okay. That means I will have to adjust only two things in the after tax profit, which is capital expenditure net of depreciation and then the change in working capital. What I want to explain you is that adjusting 5 means taking both the adjustments or treatment. So this capital expenditure net of depreciation will grow at a rate of 15% per annum, and from year 4 onwards, the normal growth period, revenues and EBIT will grow at 8%, as it was already discussed in the previous page, and the incremental capital expenditure will be offset by the depreciation. Means after year 3, the capital expenditure and the depreciation will be same. That means 10 and 10. So if you will net off both the items, it will be 0. So there will be no difference in the after tax profit. So you can skip both the parts. Adding 10 and deducting 10 will result into no change. So you can skip the working at that time. That's what the question is saying. Incremental capital expenditure will be offset by the depreciation. Offset. During both high and normal growth period, net working capital requirement will be 25% of the revenues. The weighted average cost of capital is 15%, income tax rate 30%. Question is clearly asking you to calculate free cash flows to firm. The good part is you don't have to calculate the weighted average cost of capital. It is already given to you in the question. This includes the cost of debt and equity both. Now the only thing which is required is to calculate the 4 cash flows. 3 cash flows for the first 3 years and the terminal value, that is free cash flows to firm, and make sure that you are using the present value factor only for 4 decimals. See, now we are doing the calculation. First we will take the revenue and we will increase the revenue every year by 20%. So the current revenue was 7,500 at 0th year. It is increased by 20%, 9,000, again 20%, 10,800, again 20%, and after third year, this is going to be the terminal year. See, understand, the last column is of the terminal value and it is not the 4th year, it is the end of the 3rd year itself. What do I mean to say is, actually we can call it as a 4th year cash flow, but with the 4th year cash flow, this is the 4th year cash flow, you can consider that, but with these cash flows you are going to calculate the terminal value at the end of year 3. So discounting for the terminal value will be done at the present value factor of the 3rd year. Okay sir, cool. Now once you have calculated this, the 4th year cash flow has to be like 1.08, because after 3rd year the growth rate is 8%, so 8%, right? You will increase the cost of goods sold and operating expenses. Okay, cost of goods sold and operating expenses. What the institute has done, which was not at all required, I can say, is that they have, like, you can clearly see the operating expenses here is 2250 and the operating expenses here is only 1980. How is this possible? I will tell you. Out of 2250, if you will separate the depreciation, it will come to 1650, and that 1650 is for the 0th year, and once you start increasing it by the growth rate of 20%, it will come to 1980, then again 20%, again 20%, and then 8%. So we can say out of this operating expenses, depreciation has been separated and written in a different column. However, this was not required as such. So EBIT, you have reached at the EBIT. I told you, if you are calculating the free cash flows to firm, do not deduct interest. However, the details regarding the interest is not given in the question, but even if it would have given, you would not have deducted that. Okay. EBIT, then you will deduct the tax at 30%. Okay. This will be EAT. Now is the time to adjust 3 things in that. Add back depreciation, deduct capital expenditure, and deduct change in working capital. But depreciation and capital expenditure will be adjusted together. So what was the capital expenditure net of depreciation. Can I say adding back 600 and deducting 750 of the capital expenditure, or directly deducting 150 of the net of depreciation net of capital expenditure is one and the same thing? So what I will do, I will take depreciation net of capital expenditure, which is 150 at the time 0, and then multiply it with 1.20. Am I right? Sorry, 15% is the growth in that. So what are we going to do? 15%, 1.15, 1.15, and you can clearly see in the after 3 years the depreciation and capital expenditure amount is equal. That's why adding the same amount and deducting the same amount will result into 0. So in the terminal year it will be 0. Now comes the change in working capital. Question is very much clear about the working capital requirement, which is 25% of the revenue. See, if you will calculate 25% of the revenue at time 0, 7,500 into 25%. Can I write it here? So working capital. So 0, 1, 2, 3. This comes to 1875. 25% of 7,500. Okay. Right. And then 9,000 into 25%. That's 2250. Then 10,800 into 25%, 2,700. 12,960, the third year revenue, into 25%, that's 3,240. And 13,996.80 into 25%, that's 3,499.2. Instead of applying 25% all the time on 9,000, then 10,800, what you can do is, you know that the growth in revenue was equal, like 20%. Na? So what you can do is, you can increase this 1875 by the similar percentage, 20. So if you will increase 1875 with 20%, it will give you 2250. What I want to say is, this can be calculated by two different methods. Revenue into 25% or previous working capital into 20%. Both the ways are going to give you the same figure. Now working capital is not an expenser. Working capital is the balance. So 1875 is included in 2250. So what we have to do in the first year is the balance amount only we have to deposit, or we can say we have to make a cash outflow of. So the difference between these two, 2250 minus 1875, is the increase in working capital. That is your cash outflow. This is the change in working capital, 375. Now from this point onwards, you can calculate the difference, or you can add 20% in that. Both will give you the same answer. 2700 minus 2250 is 450, or 375 plus 20% is also going to give you 450 plus 450 into 1.20, that's 540, and 3499.2 into 3240 is 259.2. So do you understand the difference between the two figures? These two figures is the change in working capital, opening and closing. See, 375, 450, 540, and in the last year it is less because of the 8% growth rate, 259. That's it. So once you adjust these three items, capital expenditure, reduce it, depreciation add back, change in working capital, you will arrive at the free cash flows to firm. Once you have arrived at this point, discount these three cash flows and calculate the terminal value at the end of year 3. So it will be cash flow for the fourth year divided by overall cost of capital minus growth. So what is the cash flow for the fourth year? 2680.13. Do not add growth again in the fourth year. It is the 8% growth is already added. You can clearly see here 8% growth is already added in 2680. This is already cash flow at the end of year 4. And then you can take the 15%, I think, weighted average cost of capital, and the growth rate is 8%. Once you calculate the terminal value, you can again take it back to time 0, and this will be your value of the firm. See, discounted the first three cash flows, and then comes the terminal value 2680 and this and this. So these two figures, this is from 1 to 3 and this is TV3. That means 4-year onwards. This is the present value of the first 3 years. This is the present value of the 4th year till perpetuity. 25,174.08. We are going to see more questions like this coming from question number 19. Let's have a look. Okay, coming over to question number 19. It's pretty much same as the previous question, but there is something new to learn. Following information are available in respect of XYZ Limited, which is expected to grow at a higher rate for 4 years, after which the growth rate will stabilize. In the previous question, it was 3 years and then the growth rate was stabilizing. In this question, it is 4 years and then the growth rate is stabilizing. The exact data is revenue, EBIT, capital expenditure and depreciation. You know what to do with the depreciation? Add back. What to do with the capital expenditure? Reduce in the EBIT after tax figure, not just the EBIT after tax. Okay. There are two phases, high growth and the stable growth. Stable growth is a perpetual. So this is for the first 4 year and this is from 5th year onwards. Growth in revenue and EBIT 20% and 10%. Growth in capital expenditure net of depreciation 20%, and then it will offset. See, exactly the same data but in the form of a table format. Now this is something new from here to here. The risk-free rate is 10%. In that phase it is 9. Equity beta is different. Market risk premium is different. So this is RF, beta and RM minus RF. This is a premium, sir. Not just the market return, it is a premium. What to do with this? This will be used in the capital asset pricing model to calculate the cost of equity. Why do we need the cost of equity? To calculate WACC. It was 15% in the previous question, but now it has to be calculated. Plus it was 15% in both the phases, high growth and stable growth, in the previous question. But in this question, the high growth will have its own cost of capital and the stable growth will have its own cost of capital. I will just take you first with the concept. First, 2, 3, 4 and then perpetuity. Now, these 4 years are high growth. This is stable growth. Okay. Now what we are going to do, we will have two different WACC. Weighted average cost of capital to discount the cash flows. So any cash flow going from these 4 years to 0th time will should be discounted at this rate. But any cash flow coming like from 5th year onwards till this point, till the end of the 4th year, should be discounted with this rate. So if you calculate the terminal value at the end of year 4, it will be first discounted with this discount rate and then it will be then discounted with this rate to reach at 0th point. Because the timing matters. For the first 4 year, the discounting rate is this. So if you take this cash flow from 4th to 0th time, this rate has to be used. Now, both the WACC will be calculated using the same concept, which is KE into weight of equity plus KD 1 minus tax into weight of debt. KD 1 minus tax into weight of debt. The formula will be same for both. But what will be different? What will be different? It is cost of equity in both, because CAPM will be used. So we are going to use CAPM twice and calculate two cost of equity. And with this two cost of equity put in this equation, calculate two WACC and then you will calculate the present value. That's something new. In the previous question, it was directly given as 15%. No need to calculate. Plus it was same for all the phases, high growth and the stable growth as well. So Let's have a look. So let's have a look now. I have explained pretty much everything. So for the high growth phase, that means for the first 4 year, this is going to be the cost of equity using CAPM. Cost of equity using CAPM. So this is the risk-free rate, beta and risk premium, 16.9% cost of equity. Cost of debt has to be taken after tax. So KD 1 minus T is 9.1%. This is our KD. Now both cost of equity and KD will be used here with 50-50% weightage. So this is going to be our cost of capital for the first 4 years. After that, again use the CAPM to calculate cost of equity, and KD after tax is 9%. This 9% and 14% used with the new weightage of debt equity ratio, that is 60-40. It was 50-50. Now it is 60-40. So these are the two rates. So two discounting rates for two different phases. Now determining the cash flows, take the revenue, increase it by 20%. Take EBIT, increase it by 20% for the first 4 year and 10% after that. Then EAT, that directly deduct tax out of it. Do not write the column or the row for the taxation, not required now. So directly deduct 30%, take the 70% of it, and you will reach at the EAT. Now there are only three things after coming to the EAT. There are only three adjustment. Add back depreciation, reduce capital expenditure. It is given in the same treatment. Capital expenditure net of depreciation. What is net of? It is just less of depreciation, and that is increasing at certain rate, which you need to understand. Let's have a look. So capital expenditure net of depreciation is increasing at 20%. So if you will calculate the capital expenditure net of depreciation, it is 80 at time 0. So start increasing that by 20% and you will get the values for the first 4 year only. So it is like 80 into 1.20 into 1.20 into 1.20 into 1.20. That's it. It is 0 at the end. See, it is offset by the depreciation, and that's why 0. Now working capital is an important factor. You can see there is something related to working capital. For all the time, the working capital is 25% of the revenue. So what are you going to do? Just write down a column of working capital, and you can, if you want to just understand that, calculate the 25% of the revenue, and then what you have to do is take the difference. Take the difference of the two figures. I will just show you. So the revenue was 2000 at time 0. What is the 25% of it? It's 500. 25% of 2400 is 600. So the working capital at 0 and the 1 year end is 500 and 600. That means how much is the additional working capital? 100. 500 plus 100. Now, if you will go here, it will be like 720. 2880 into 25%, 720. So it's 120. The difference between opening and closing working capital. This is how we calculate. You can calculate the difference. You can calculate by taking the difference between these two, or at least for the first year, you can follow the same growth. That is 20%. If you will increase the 20% at 100, it will be 120 and 120 and 120. But afterwards, it will slow down. After 172, it will be like 25% of this. 4561.92 into 25% goes to 1140.48, and 4147.20 into 25% is 1036.8. So the difference between these two is 103.68. It's just the 10% of it. 1036 is 10% is 103.68. That's 103.68. So this is how you can calculate the free cash flow to firm. Now understand, these 4 cash flows has to be discounted at 13% for WACC, and now this will be used to calculate terminal value at the end of year 4 with 12% WACC. 12%. Okay, this is the same thing. See, in this alternative part, they have added the depreciation separately and deducted the capital expenditure. But don't do that. It will give the same answer, but plus writing this much will take a lot of time. Let's go to the next page. See 13% has been used for the first 4 years and 12% is used for the 4th year terminal value. So this is the terminal value at the end of year 4 with the cash flow of the year 5, and 375 already includes 10% growth rate. There is no need to do the additional working in that. Okay, the growth rate was 10%. So 18766, with the help of cash flow 5th year, you will arrive at the terminal value of 4th year, and the 4th year factor is 0.613. 4th year factor is 0.613, and the present value of that is 11,503.56. So for the first 4 year it is 217, and after that it is 11,503. Once you will add it, you will get the value of the firm. Rest of the treatment is same as question number 18. So 18 and 19 were pretty much same, except for the new learning, which was there were 2 different cost of capital for the stable and the high growth period. That's what we had to understand. Okay, question number 20 is homework. It is much like question number 21, but 21 is little difficult than 20, so that's why I will take 21 first. Have a look. See, calculate the value of shares from the following information. Value of the share. Share is equity related. Now, profit after tax of the company is given to you. Equity capital is also given. Par value of the share. Do you understand what exactly you can calculate with these two figures? Par value of the share and equity value of the company. You can calculate the number of shares. And when you take the profit after tax and number of share, what exactly you can calculate? You can calculate with the help of these two, which is EPS, earning per share. And what are we going to do with the earning per share? Can we calculate the value of the share using EPS? No, sir. We have to convert that EPS into cash flow. It is right now only earning. We have to adjust those 3 things: depreciation, capital expenditure, and working capital in order to convert that earning. Since this EPS, this figure, this earning is per share. So the depreciation that you are going to add back will also be per share, capital expenditure per share, working capital per share, in order to convert it into free cash flow to equity. Why equity, not the firm? Because value of the share means equity share, and we need FCFE for that. Okay, debt to equity ratio of the company, debt to equity ratio of the proxy company, another company, beta of the proxy company. Now understand where the things are going on. Long run growth rate. This is long run growth rate, risk free rate of interest, market return. Okay, now these 3 figures will help you to calculate CAPM data, but one thing is missing in that, which is beta. And now the beta related information will be here. Beta, everything related to beta. Now this is CAPM. Okay, now capital expenditure per share, depreciation per share, and change in working capital. Assume the corporate tax rate to be 30% and beta of the debt as 0. Beta of the debt as 0. But understand one thing. In the previous question, you used these figures, capital expenditure, depreciation, and change in working capital, to calculate the free cash flow to firm. At that time, it included debt and equity both, and that's why you could deduct the capital expenditure entirely 47, depreciation add entirely 39, and deduct this change in working capital. But now you are only calculating FCFE. See, FCFF included debt and equity. Now it is only equity. So once you decide to deduct capex, in the previous question it was easy to deduct the capex, like 47, add back depreciation, and deduct change in working capital as 39 and 3.45. Do you think the exact same figures can be put here when you are taking only FCFE? No, sir. You need to, since you have removed the effect, or we can say removed the debt from FCFE, you need to remove the effect or the contribution of the debt also from these three figures. You need to take the equal share of equity only. What does that mean? It means that we will assume that if we are required to contribute 47 towards the capital expenditure, 47 euros, then that contribution has to be from both the investors, because in this company there is a debt and equity both. So what these people are? These are the capital contributors. Do you agree? Equity is also contributing to the capital of the company. Debt is also contributing to the capital of the company. And this is what the capital requirement is. So if 47 is required, it will be contributed by the debt and equity in their ratio 1:3. 1:3. So what exactly you have to do? You have to divide all those figures into debt sharing and equity sharing. Out of 4 euros, 1 will be contributed by the debt and 3 will be contributed by the equity. So can I say 75% is the equity sharing? Out of 4 euros, 3 euros relates to the equity. So 3 by 4 is 75% is the share of equity. So even if you take 75% of these capital expenditure, depreciation and working capital, you can adjust that here. That is what the main thing to understand and learn about. You just need to take the 75%. 75% of 47, 75% of 39, 75% of 3.45. Why? Because 25% relates to the debt. All the capital that will be contributed to the company has to be in this ratio. Why? Because if you ask equity shareholder to entirely contribute 47 euros, then what will happen? The debt to equity ratio of the company will get affected and it will no more be 1:3. We have to maintain that. It means whatever the debt capital requirement is, it should be divided in this part in order to keep the ratio. That's what we are going to do here. So looking at the entire picture, there are 3 to 4 steps. Market price of the equity share will be calculated as free cash flow to equity into 1 plus growth divided by cost of equity minus growth, using the Gordon's growth model, because the growth rate is given here. See, 8%. So this is related to CAPM and this is Gordon growth model. Now we have only growth given in the question. You can see 8%. So we need to calculate the FCFE as well and cost of equity. Let's first focus on the FCFE, free cash flow to equity. Now free cash flow to equity is equal to, it's very simple. It's exactly the same as we learned in the previous question, but in the previous question it was on the total basis. Total market value, total debt, total depreciation, total capital expenditure. In this, it is on per share basis. So we need earning per share. Earning per share is always after tax, right? So instead of earning after tax, it will be earning per share. And then we can say we will add back depreciation per share, deduct capex, and then change in working capital. But it has to be in the equity sharing ratio. So 75% of the total only will be deducted. Do you get that? Now how to calculate the EPS? EPS is nothing but the profit after tax divided by the number of share. How to calculate the number of share? Equity capital divided by par value. So you will start with these figures. I will just write it down once again to give you the flow. The ultimate is to calculate the market price, which will be FCFE into 1 plus growth divided by cost of equity minus growth. We have the growth rate as 1.08 minus 0.08. Now we are going to shift this step into 2 different parts. So here we are going to start calculating free cash flow to equity. It will be earning per share. Okay. Add back depreciation. So 75% of the depreciation minus 75% of the capex minus 75% of the change in working capital. Am I right? Do you understand the logic of 75%? Because 25% will go to the debt portion. If it would have been FCFF, then we would have deducted or added 100% of the figure, because FF means free cash flow to firm includes both debt and equity. So if both the people are here, then 100% will be contributed by them. If debt holder is standing somewhere else, a portion or allot their share of depreciation, capex and change in working capital to that working. Okay, so earning per share is now to be calculated as profit after tax divided by number of share. Number of share again will be calculated as equity capital divided by par value. Okay, so you will take the equity capital divided by par value, you will get the number of share, put it here, you will get the EPS, and then you have all the figures in this. So you can easily calculate the FCFE. Now coming over to the cost of equity. Cost of equity is equal to risk-free rate plus beta in bracket market return minus risk-free return. You have everything in this question except for the beta, and we need that levered beta, not just the beta, levered beta. Why? Because in this question, in our company, we can say we have a debt. So if we have a debt in the company, we need a levered beta. And the beta of our company is not given. The beta of the proxy company is given to us. What will happen? Can we use that? Yes, we would have used that if the proxy company's debt equity ratio was same as ours, and we can clearly see that the proxy company's debt equity ratio is not same as ours. That means the risk of the debt in our company is different than the risk of the debt in their company. So first, what we are going to do, we are going to convert the proxy company's levered beta to unlevered beta. That means we are removing the debt of proxy company, and then again we are going to add our debt in that and calculate the levered beta. So understand the procedure now. What are we going to do? The proxy company's levered beta will be converted to unlevered beta. That means we are going to remove the 1:2 ratio of the proxy company's debt equity, and then we are going to add 1:3 risk or the debt ratio, and again calculate the levered beta. This levered beta will be used in the cost of equity, and then it will be used here. This is question number. Do you understand this procedure? So let's calculate what is the formula for levered beta. Levered beta is equal to unlevered beta 1 plus debt equity ratio in bracket 1 minus tax. The levered beta is 0.20, right? Unlevered beta, their debt equity ratio is 1:2, and the tax rate is the tax rate is 30%. The debt beta is 0, so the tax rate is 30%. And now you can calculate the unlevered beta. Please understand, the unlevered beta will always be lower than the levered beta. It is 0.20, right? 1.35. It will be 0.1481. Now convert that back. What we have done till now is removed the risk of proxy company, and now we are going to add the risk of our company. See what I am doing. So I will take this levered beta 0.1, unlevered beta 0.1481, and I will add the risk of our company 1:3. That's the major difference in the previous calculation and this one. See, I will just highlight that. It was 1:2, now it is 1:3. We were removing 1:2 and adding 1:3 now. That goes to 0.1827. You can put this 0.1827 here calculate the cost of equity and put it in this formula. You will get the final values. Now I'm just going directly to the answer so that I can explain the answer along with this. See, first we calculated the number of share, that is 325 million. We put that number of share here in order to calculate the EPS. So profit after tax divided by EPS, this is our EPS. Now FCFE, understand, net income minus capital expenditure, and you can clearly see, you need to just understand this minus, and we can say this minus will change the sign of depreciation to plus. So if you go by this way also, the answer will be same, or else you can do it like this also. I will just show you both the ways. So let's first do it our way. 8.923, right? So what is the earning per share? 8.923 plus 75% of the depreciation. Total depreciation is 39. Take the 75% of that, which is 29.25, minus 75% of the capital expenditure. 47 into 75% is 35.25, minus 75% of the working capital, 2.5875. Why are you taking 75%? Because that's the only share of equity shareholders. 8.923, add back depreciation 29.25, deduct capital expenditure 35.25, minus 2.5875, that goes to 0.3355. Let's check that, 0.3355. Now try to understand that. What is 1 minus B, sir? A lot of student asks this. 1 minus B. B is the debt ratio in the company. B is the debt ratio in the company. So if you do that, what do you come up with? It is 75% itself, na? 1 minus 0.25 is nothing but 75%, and 75% is the share of equity. So we are making sure that out of the total capital requirement, debt share is separated and the equity share is separated. Equity share will be adjusted with the equity's earnings, 0.3355. Okay, now what are we going to do? We are going to convert the geared beta to ungeared beta, 0.148, and then we are going to again convert that to 0.1825 geared equity of ours. So that is 0.1827 it is 0.1825. Now I will just write it in a simple form. Geared beta to ungeared, right, and again to geared. So what we did here is we removed 1:2 ratio, and then we made sure we add 1:3 ratio. So the figures were like this, from 0.20 to 0.148 and again to 0.1825. So we used this 0.1825 in the CAPM to calculate the cost of equity. Now we have this FCFE and the cost of equity. So FCFE, growth rate, cost of equity, and so there is a slight change here. It should be 0.08992 instead of 0.8992. 0.08992. The answer is correct. It's just the printing mistake. So 0.36234 divided by this, 36.53 is your answer. This is how you have calculated every step. Question number 20 is like that only. Acha, this is question number 21, right? I will just mark it as 21. Quite good question, na? It was asked for 8 marks in mock test paper of August 16, and the previous question is like that only, and it was asked in June 2009 exam, and I think no other exams. Always it has been asked in RTP. Latest RTP May 2020 it was asked in. Chalo. Question number 22 is your homework. Coming 2-3 questions are quite similar, so I'm going to take the one which is very important, which is little difficult. So question number 22 is homework. 23 is again homework. Okay. I am going to take, I think, question number 24. Have a look on this. Question number 24 now. So have a look. Following details are available for X Limited. Income statement is given. Income, sales, gross profit, administrative expenses, profit before tax, tax, profit after tax. Everything is given up here. Balance sheet, fixed asset, current assets, total assets, equity share, creditors, and then liabilities. Okay. Now, the company is contemplating for the new sales strategy. And it is just like question that we have seen, couple of questions that we have seen earlier. Sales will grow at 30% per year for the next 4 years. Okay. So 1, 2, 3, 4. The growth rate will be like this 30%. If this is growing 30%, this will also grow 30%, 30%, 30%, 30% and 30%. You can straight away take profit after tax if there is no other change. Let's see. Asset turnover ratio, net profit ratio and tax rate will remain same. See, if asset turnover ratio, net profit ratio and the tax rate will remain same, what does that mean? If the turnover is growing by 30%, the assets, net profit will also grow by 30% if the ratios are same. So, asset turnover ratio means the total assets like fixed assets and the current assets as well. Depreciation will be 15% of the value of the net fixed assets at the beginning of the year. Whatever the fixed assets are at the beginning of the year, it will be 15%. So what the very first thing that I think we should do is increase the sales. Like write down all the sales for the next 4 years, because based on that you can increase the assets in the next 4 year, current assets also. Once you calculate the fixed assets, you can easily calculate the depreciation, because you have to take the 15% of the opening, 15% of the previous year's closing. Required rate of return is 15%. Evaluate the viability of the new strategy. It's just a matter of calculation. Just a matter of calculation. Have a look. What else is given in this question? Nothing. Let's see. Yeah. The main point of the question is there is nothing related to perpetuity. We have seen that in the previous questions, that there was something perpetual, stable growth rate, but there is no stable growth rate here. What does that mean? Do you think the companies the company is going to go flat or shut down after 4 years? No, sir. This strategy will increase the sales for the next 4 years, and after 4 years there will be no growth, but the company will keep going on. So perpetuity calculations will be there, but without growth. Okay. So you can simply divide it by 15%, the 5th year cash flows. So let's have a look on this now. It was 40,000, right? Sales. They have prepared a balance sheet here, but I think they should have first written the sales figure. So from 40,000 to 1.30 and 1.30 and 1.30 and 1.30. For the next 4 years, you are going to increase that by 30%. So I will tell you one thing. You will increase that PBT also, PAT also by 30%, and I think the depreciation as well. So this much of the items you will increase by 30%. I will just recalculate it once again. Depreciation. Acha na, depreciation is to be calculated separately. Cool. So if we first find out the fixed asset turnover ratio or current asset turnover ratio, we can clearly see that fixed assets divided by sales is 25%. Am I right? 10,000 divided by 40,000. And current assets divided by sales is somewhere around 6,000 by 40,000. That's 15%. So you need to make sure these rates are common, like these rates are kept constant. Now, once you calculate the sales in the second working shown here, you can easily calculate the fixed assets for every year 1, 2, 3, 4, 5, current assets 1, 2, 3, 4, 5, and you can see there is no change in the fourth and the fifth year here in the fixed assets and current assets. Then you will ask why did we take that? It has a reason. Okay, because there is no growth after fourth year. So fourth year fixed assets will continue forever, current assets will continue forever. So if you have to calculate the change in working capital, you can easily do that by taking the opening current assets minus 7,800, then 7,800 and 10,140 is difference. The difference between these two will be the change in working capital for second year. Acha, how to calculate the capital expenditure? Question clearly says that fixed assets was 10,000 in the first year, right? So for the 0th point, it was 10,000. Question clearly says that the depreciation will be 15% of the opening fixed assets. So 15% will be 1,500. So the depreciation for the first year will be 1,500. 13,000 into 15%, 1,950 for the next year. And understand the fact that this is growing at a same percentage. So depreciation will also grow at a 30%. If you will increase 13,000 by 30%, it will come to this. So if you will increase 1,500 by 30%, it will come to this. Again 30% and again 30%. It will be same, but you will have to do it till fourth year only. Just a second. So 1950 plus 30%, that's 2535. So you add 30% in 1950 or take 15% of 16,900 opening fixed assets. You will get the same value, 3295.5. And in this case also, 28,561 into 15%, that's 4284.15. So this is how the depreciation will go on. Now, how will you calculate the capital expenditure? Capital expenditure is very simple, sir. If this is a fixed assets account, opening will be here, closing will be here, and depreciation you will write here, like depreciation account debit to fixed assets. So the balance amount will always be of capital expenditure, isn't it? So let's take the first figure, 10,000, 13,000 and 1,500. So if you write down these figures, 10,000 is the opening, 13,000 is the closing, 1,500 is written here. What does that mean? It means the capital expenditure is 1,500. 4,500. Capital expenditure is 4,500. So this is like 14,500. This is also 14,500. So how do you calculate the capital expenditure? It's very simple, sir. Closing balance plus depreciation minus opening balance. You have to do it at every point to calculate the capital expenditure. Have a look. So closing balance 13,000 plus depreciation minus opening balance will give you the capital expenditure here also 16,900 plus 1,950 minus 13,000 will give us the capital expenditure, which comes to 5,850. Let's check that in the calculation. Next page. See, 5,850. Okay, so I will just write down the formulas. Opening fixed assets multiplied by 15% is the depreciation. Addition to fixed assets is very simple. Closing fixed assets, I will write down here. Closing fixed assets plus depreciation minus opening fixed assets. And once you calculate that, it will be very easy for you, because you have to just multiply 1.30, 4,500 into 1.30, 1.30, 1.30. Right, you have to do it like this easily. Then increase in the current assets, net current assets. Again the same thing you have to calculate for the first. It was 6,000 in the beginning, right? See, it was 6,000 in the beginning. What is the increase? It is 1800. And once you take 1800, add 30% continuously for the 4 years. And in the last year, you can see in the 4th and the 5th year, there will be no increase in the current assets because the sales is same. So where is that? 1800 or 1500? Let me just check once again. It should be 1800. Yeah, there is a slight mistake I think in these figures. These are the figures of depreciation which has been written over here, which needs a correction. I don't know if it is the mistake in the institute's material or what, but we will need to make a correction here. So just write down 1800. 1800 plus 30% goes to 2340 plus 30% goes to 3042 plus 30% goes to 3954.6 and then 0. 0 is right. Let me do the total once again. So these are the three things. How to calculate depreciation: opening fixed assets plus 15%, closing fixed assets, addition to fixed assets is closing plus depreciation minus opening. Closing plus depreciation minus opening. Increase in the net current assets is very simple. In the previous page, take the difference between opening and closing. You will have the figures. And now let's calculate the cash flow. How to do that? In profit after tax, add depreciation, deduct capex and deduct increase in working capital. So 5460 plus 1500 minus 4500 minus 1800. So the net answer should be 660. I think there is a mistake in the institute's calculation as well in this. Otherwise, if there would have been a printing mistake now, the final answer would have been same. But now I can clearly see that this is a different. Let me check once again if there is a difference. So the answer will change to certain extent. Okay, so final answer will change. Let me just write it down. 7098 plus 1950 minus 5850 minus 2340 will give you 858 2535 2535 plus 9227.40 plus 2535 minus 5 minus 3042. That's 1115.4. Eleven nine nine 5.62 3295.50 minus 9886.50 minus 3954. That's 1450.02. You can see capital expenditure is net of depreciation in the last part. So even if you take 0, it's not going to get affected. So yes, there are some changes in the final answer as well. 660, 858, 115.40 and 1450.02. What you need to do is cancel these items. The entire answer will change. Multiply this present value with the present value factor and then you can calculate the present value here. This answer will change. The terminal value will remain same. The residual value we can say. This is the 5th year's cash flow and straight away divided by 0.15 because there is no growth rate. So we are not adding it in the numerator, not deducting it from the denominator. This is the terminal value at the end of year 4. Which will be discounted at the 4th year factor to calculate the present value of the terminal value, residual value, present value of residual value. So this present value here and the correct value of this 4052, not 4052 exactly, the correct value has to be added. So after implementing the new strategy, the value of the company will be 49,795.95. Now understand, question is asking us about the value of the strategy, not the value of the company. Do you understand the difference between this? See, the question is saying evaluate the viability of the new strategy. So what does that mean? If we do not follow or do not implement the new sales strategy, what will happen? This growth won't happen. Simple. If the growth won't happen, this is going to be 4200 and we can say, yeah, we don't have the depreciation for 0th time, capital expenditure and the working capital. So by default, this is not appropriate, but by default, we are going to assume this as a cash flow after tax 4200, and we can just capitalize that to calculate the value of the company, existing value of the company. Pre-strategy value of the company is 4200 divided by 15%. So we capitalized the earnings capitalization method. And accordingly, we are coming to this point that our company's value is 28,000 before strategy, but after implementing the strategy, it is coming somewhere like 49,000. So value of the strategy is 21,000. The difference between this and this, and since it is positive, it is viable. The only thing that you have to change here is this last factor of increase in the net current assets, which will change these figures and rest of the figures. I will check once again this question later on, and if there are certain changes, like if these values are correct, 1500 and all that, I will inform you guys through a PDF. There will be a PDF of all the corrections in the compiler 4th edition. So in that you will get to know about it. Otherwise, if this is correct, I will just add that and change everything. Okay, sir. So this was all about the strategy thing. The previous two questions that I gave you was also on the strategy itself. See, in the previous question of that, you can see the residual value, present value, total shareholders value. This is the new value, but pre-strategy value was again 1400 divided by 15. That means earnings capitalization. So pre-strategy value was higher than the new strategy value, and that's why the strategy is not viable, because the answer is negative. And in the previous question to this one also, you can see the strategy, along with the strategy, it's negative. I feel there are lots of ambiguities in all the three questions, and that's why this random figure of minus 1,75,000 is coming as compared to positive 93,000. So that is where these questions seems like incomplete with the data. Now let's come to question number 25. What you have to take, irrespective of the ambiguities or the mistakes in the question, what you should take from that question for your exam is the approach of calculating the value. That's it. Now this is a new question, BRS incorporation. This is one of the amazing and one of the toughest question of the entire corporate valuation. So let's focus on that. BRS incorporation deals in the computer and IT hardware and peripherals. The expected revenue for the next 8 years is given to us. See, the revenue for the next 8 years is given to us, right? Now, summarize financial position as on 31st March 2012 is as follows. Have a look. Equity stocks on the liability side, 12% bonds, and these are in millions. Understand? Dollar in millions. So this is also in million. 12 million, 8 million, total 20, fixed assets. Net means after deducting depreciation, this is current assets. Cool. Now, additional information. Its variable expenses are 40% of the sales revenue, and fixed operating expenses are estimated to be as follows. See, we have to reach to the point where we can calculate the free cash flow to firm. So the very first thing to consider is sales, less variable expenses, less fixed expenses. For the first 4 years, every year the fixed expenses will be 1.6 million, and for the last 4 years, every year it will be 5 to 8 years, it will be $2 million every year. Okay, so we have got to this. Now another expense. This is the first expense, this is the second expense. Additional advertisement. Acha, one more thing. Before moving over to the second point, let's come back to fixed operating expenses, and you can see there is a bracket here in which cash is written. What does that mean? It means that in that fixed operating expense, depreciation is not included. Got it? Depreciation is not included in that. An additional advertisement expense and sales promotion campaign shall be launched requiring the expenditure like this. For the first year, it will be this. For the second and third year, every year 1.5 and 1.5. 4, 5, 6, it will be 3 and 3 and 3. 7 and 8, it will be 1 and 1. So it is like this. Now, fixed assets are subject to depreciation at 15% as per WDV method. So we'll have to calculate the fixed assets. That is 17 right now. And on the basis of that, you will calculate the depreciation. 17 less 15%, then closing balance. That will become opening balance in the next year. Then again 15%. Cool. The company has planned an additional capital expenditure in the beginning of each year for the coming 8 years as follows. So this will be at the beginning of each year. What does that mean? It means that this capital expenditure is subject to 100% depreciation. Like it is used for the entire year. And in the income tax also, we can deduct the calculate the depreciation entirely on this. Okay. So for the coming 8 years, it is like this. So you are going to make a proper working of the fixed assets, having a opening balance. Okay. Then you will add capex. Then let me just check the depreciation. The depreciation is on WDV basis, right? Capex, and then what you can do is you can just calculate depreciation, total value. We can calculate the total first of these two, then calculate depreciation, and that will be closing after that. Our total minus depreciation will be closing, and that closing will be opening again. Investment in working capital is estimated to be 20% of the revenue. We have seen these types of questions. Applicable tax rate is 30%, cost of equity is 16%. The free cash flow to the firm is expected to grow at 5% per annum after 8 years. So this is a growth rate. To calculate the terminal value, TV8. We have to calculate the value of the firm and value of the equity. Once we calculate the value of the firm, we can deduct debt out of it to calculate the value of the equity. So first we are going to focus on the value of the firm. And please understand, this is the cost of equity only. We have to multiply it with the weight and cost of debt, 1 minus tax, again weight of debt. We have to calculate WACC and use it with the firm cash flows to discount the firm cash flows and to calculate the value of the firm. Now step by step. See. The major part is your profit first. Sales minus variable expense minus fixed expense. Apart from that, there is an advertisement expense, right? And depreciation also. And then you will reach at EBIT. I think there is no other expense. Then you can deduct tax out of it. Do not deduct interest because we have to calculate value of the firm. So forget about 12% of the interest on it. Forget about that. You cannot deduct it. Okay. So EBIT minus tax. You will reach at EAT after tax, and then you will add back depreciation in that. And then there are only 3 things. Now, capex. First of all, capex is already given to you, and then change in working capital. That's it. So this is how you have to calculate. This will give you free cash flows to firm, which you will use with the growth rate and overall cost of capital minus growth rate. Cost of debt is this KD 1 minus tax into weight. So you can see 12 is the equity, 8 is the bond. So can I say this is 60%? This is 60% and this is 40% of the total. So we have the weights, we have cost of equity on the next page, we have cost of debt here, we have tax also. So WACC is quite easy. The most difficult part will be to understand the calculation of capex and working capital. So one by one, we are going to look at the answers. Have a look. See, weighted average cost of capital. It's very simple. Equity stock, cost of equity. This is KD 1 minus tax, 8.4. 60 and 40%. So you will multiply 16 with 60% and 8.4 with 40%. And this is your answer, 12.96 or 13. Do not do it in exam. If the 12.96 is answer, keep it as final and calculate the answers accordingly. Making it 13% will not be a correct idea. I don't know why the institute has done it. I mean, how the students will get to know about it? If it will be 12.94, will you still take 13%? And what if the institute doesn't take it in the suggested answer? You will end up getting no marks. Okay, this is the calculation of depreciation. Opening fixed asset was 17, right? So in that 17, what you can do? You can add the capital expenditure of 0.50 for the first year. So 17.50 and then calculate the depreciation on that. See, this is the opening fixed asset used for the entire year. This is the addition made in the beginning of the year itself. So this is also used for the entire year. So for the entire year, 17.50 was the fixed assets used. So we will calculate depreciation on that. Instead of adding one closing balance column here, we can save that time by directly deducting 17.50 minus 2.63 and taking the value here as a opening balance. Because anyhow that closing balance will be written again herein as an opening balance. So straight away write it here. If you are smart enough, you can reduce that column. If you don't want to make mistakes and you are okay with practicing, so you can calculate or you can put down that closing balance column as well. Cool. So 14.87. Now again add the depreciation of 0.80. 14.87 plus 0.80 is equal to this multiplied by 15%. And then 15.67 minus depreciation is like this. Or we can say 15.67 into 85%. It's one and the same thing, right? You can do it like this and calculate the depreciation. This is required. The last column is required to us for profit. So in this way, you will reach at this point. The most important part is the determination of this investment. We will come to this point later. I will just skip it right now. And I will come down to this part, determination of the present value. See, you will take revenues. Revenues was given for 8 straight years in the question itself. Now you will take the variable cost as per the percentage. I think that is 40%. 40% of the revenue, it's very easy to take. Fixed operating cost, you can clearly see $1.6 million for the first 4 years and $2 million for the last 4 years. Then advertisement cost accordingly, depreciation from that schedule. I told you these are the only expenses. You can go through the question once again and see if there is anything left. Don't just audit the answer. I'm going through it because it's the fast track batch. You should do the practice of it. That's very much important. Writing is very much important. This is the total expense EBIT, and see, we have not deducted interest here. Once you deduct the interest, the remaining cash will be only for equity, not for debt. So with that cash, we can only calculate value of the equity, not the firm. So that's why no net operating profit after tax. This is operating profit because interest was yet to deduct, like not yet deducted. So once you calculate that, you have to do only 3 things. Add back depreciation, less capital expenditure, less change in working capital. Now is the time to first add back depreciation. So see, they have added the depreciation here. Gross cash flow, add back the depreciation. And in the next working, what they did is they deducted the capex and the current asset together. And this is the working that you need to understand now. Now try to understand few things. This is going to be a complicated part. What is the sales revenue for the first year? $8 million. And the requirement of working capital is 20% of the sales revenue. So the closing balance in the working capital or the current assets, because there is no current liabilities, so current asset itself is the working capital. So the closing balance requirement is 1.6 and the current balance in the current asset is 3 million. That means we already have $1.4 million extra in the current asset. Right? So in the very first year, there is no additional working capital required, 0. Apart from that, the first year capital expenditure will also be funded first year's capital expenditure will also be funded from the extra current asset lying in the balance sheet. So it will be like this. I will just share with you. 8 into 20% is 1.6 required balance in current asset. But existing balance in current asset is 3. That means additional balance, or we can say not additional, already we have extra balance of 1.4, and capex will also be funded out of it, and still we will be left with a balance of 0.9. True? Extra balance of 0.9, or we can say the closing balance of current asset here will be very simple. We have 3 million. We have 3 million in the balance. Nothing is required for the current assets because current asset requirement is below what is right now. Yes, capital expenditure of 0.5 is required, which we are going to use it from the existing cash balance. So the closing balance will be 2.5. The difference between 3 and 0.5. Okay. And we clearly know that out of this extra 1.4, we can use this 0.5. So 2.5 will be the current asset, closing current asset. That means in the first year, zero capital is required. Zero. Do you get that? No extra capital is required, invested in the company, or we can say we need from the equity or debt holders, because we already have an extra in the balance. Okay. Another way of writing this can be like this. The existing current asset balance is 3. Required current asset balance is 1.6. That means you are already in extra. Now, required is 1.6. We need a capex of 0.5. So the total funds required for the capital expenditure and current asset is 2.1. 1.6 plus 0.5, which is more than the current, which can be, this 2.1 can be covered in the existing current assets. No additional funds are required, not for the current assets, not for the capital expenditure. That's capital expenditure will also be funded from the existing current asset itself, and we will close the current assets at this value. Not this value properly, it will be 3 minus 0.5. That's 2.5. This is going to be the closing current assets. So funds required. How much additional funds are required from outside? You tell me. From outside, how much equity should contribute or how much debt should contribute? 0. Because we need 2.1 and we have 3. We have 3 in the balance. So why would we add more funds from the equity and debt holders? 0. Okay. What will happen for the next year? For the next year, the sales, let me just check the sales. Sales is $10 million. That means the total balance required in the current assets is $2 million, right? Let's go with that now. So can I take the existing current asset balance in the second year is 2.5, because out of 3, I have used 0.5 for the capital expenditure. Now for the second year, 2.5 is left. And what is the required balance? Only 2. $10 million of the revenue multiplied by 20%. That means again I am having an extra balance of current assets. But the capital expenditure required is 0.80. 0.80. What does that mean? The total funds required is 2.80. The total fund required is 2.80, and we need to maintain a balance in the required current assets is as 2, and we have a 2.5 as the current balance. What does that mean? 2.5 and 2.8. 0.3 is required. 0.3 is required from outside. So what will happen? In 2.5 you will add 2.30, it will become 2.80, and out of that 0.80 will be used for capital expenditure, and the closing balance will be 2. So it will be like this, I will tell you. Opening current assets plus funds required is equal to total current assets minus capex used out of this is equal to closing current assets. Now have a look. In the very first year, 3 was the balance. So total current assets was 3. Capital expenditure required was 0.5 and the closing was 2.5. So we had an extra, right? And funds required, closing current assets. Cool. This was 0 at that time. Now what happened? 2.5 is the current opening current assets. Now how much is the total current assets right now? It will be like 2.5 plus whatever the funds are. But you need to make sure that this closing current assets should not go below 20% of the sales. And in the second year, 20% of the sales is 2.0. So it should not go below 2. It can stay above 2. So, and what is the capital expenditure required? 0.80. So after deducting 0.80, if we need the closing current assets at 2, it should be 2.8. And if the total has to be 2.8, we only have 2.5. That means now we only required 0.30 from outside. So 0.30 is only required to be funded. For the second year, we will present that the capital required is 0.30. This is the capital required for both current assets and the capital expenditure, because rest of the requirement can be fulfilled from the existing current assets. Now the current asset balance is exactly on the same level which is required. From the third year onwards, you won't face any kind of a problem. So 2, and you can see, I will just go to, just remember this 0 and 3. 0 and 0.30, and I will just show you the working here. 0 and 0.30. Now coming back to this, capital expenditure required in the first year is 0.50 and current assets required according to the requirement was 1.6. So the maximum that we can keep, the minimum that we have to keep in the current assets is 2.1. We already had 3, so there was no funds required. True? Okay. In the next year it was 0.80 and the current assets required was 2. The total required was 2.8, but we had only 2.5 because we used 0.5 out of this. So additional required was 3.30. Now we have a proper balance of 2. This balance is now maintained. So now this is the balance from the third year. This is the balance from the fourth. Then the balance is properly kept. And now you can calculate all the other figures as properly. So that means current expenditure is 2, capital expenditure is 2, and 20% of the, 20% of the sales revenue is 3. It was 2 in the beginning. So 2 and 3 is, 1 more is required here, and 2 is required for capital expenditure. 1 is required for current assets, 2 is required for capital expenditure, total 3. You can do it here as well. 1.4 is required for the current assets because current assets are growing, right? 1.4 is required for that, and 2.5 for capital expenditure. So 1.4 and 2.5 is 3.9. It's very simple now. From the third year onwards, it's everything is according to what we have seen in the previous questions as well. Balance in the current assets in year 1 is used for the capital expenditure. It was 3 and the capital expenditure was 0.5 and that made it 2.5. Similarly, in second year, the balance was 2.8 and 0.80. 2.5 plus 0.30 was funded and minus 0.80 was required. So 2 was the balance. For the first 2 years only, you need to understand this logic of using, logic of using the current assets for the capital expenditure purposes also. So for the first 2 years, you will find this kind of situation. From the third year onwards, you will have the normal calculation. So in this part, the working capital and the fixed assets capital expenditure is merged. Depreciation is added here and both the other items are deducted here. Then you arrived at the free cash flows. This is the present value factor. 13% you calculated as the WACC, 12.96, remember? And then the present value. But this is the present value only for the first 8 years. What about the perpetuity? See, total present value. And then the perpetuity, continuing value. They said that it will grow at 1.05. Which amount will grow? The 8th year value, 6.54. It will grow at 5%. This is the cost of capital. This is the growth rate. And this is the value at the end of terminal value at the end of 8th year. We have to calculate the discounted value of that also. So if we will go with this part, this is the discounting rate and it will come to 0.37632. So this is one value, this is another value, the total of this is 18.549. So first 8 years is covered under this, and then after that the perpetuity value is under 32. So present value of cash flow during the explicit period, that means 1 to 8 years, and after 8 years, 8 to, or we can say 9 onwards, is this continuing value or terminal value. This is the total value of the firm, 50.8239. Rest everything is easy. Out of that 50.8239, you can deduct the value of the debt to arrive at the value of equity, because firm includes both. What is the difference between the value of the firm and value of equity? The value of the debt, which is 8 million. This is arrived from the balance sheet itself directly, and this becomes the value of equity. Rest everything is same. The only part to understand in the entire question is the current assets and capital asset. What happened in this question is the required current assets was lesser than the existing balance, and that's why instead of removing the current assets, we do not do this, right? If we have an extra balance of current assets, we do not remove it from the company. We just keep it and we will use it for the capital expenditure. Understand that till now, whatever the capital expenditure was required, it was contributed by equity and debt holders. But in this part, for the first 2 years, not the entire capital expenditure has to be contributed. In the first year, we had sufficient funds in the current assets to contribute or to fund the capital expenditure. When the company itself can fund the capital expenditure, why there is an extra fund required from the equity and debt? That's why 0. And in the second year also, we needed a capital expenditure of 0.8, but we had an extra balance of 0.5 in the current assets. So we used that, and the balance 0.3 was funded by equity and debt holders. And now from the third year onwards, whatever is required was funded by the equity and debt holders. Simple. Okay, sir. Let's move on to the next question. Achha, question number 26 I'm leaving. I will show you why I'm leaving. It is very, very ambiguous. There is a problem in the question. I will show you why. See, one of the problem here can be traced. Growth rate is 8% from 2010 to 14, and beyond 2014 means 2015 onwards, right? Perpetuity starts from 2015, but they have given free cash flows of this from 2014 onwards. So that 1 year was included in the perpetuity also and in the normal growth rate also. That has made everything confusing. Apart from that, I will show you. Profit after tax is 17.2 lakhs, right? EBIT is 245 lakhs. So let me just write down EBIT as 245 and interest expense of 218.125. So EBT will be 26.875. Now is the time to deduct tax, but the tax rate is not given in the question. You can clearly see. It's okay. If the tax rate is not given, we can take the profit after tax directly, which is given to us, which is 17.2 lakhs, right? Based on that, we can calculate the tax rate. So 17.2 divided by 26.875 comes to 64%. That means the tax rate is 36%. This is proper. You can see the tax rate is 36%. It's very easy. If you know the two figures like profit after tax and earning before tax, you can easily calculate the tax. But one more thing which needs to, yeah, this much is okay. You can use this one also. This is properly given. Capital expenditure, depreciation. You can see the capital expenditure and depreciation is same. That means you don't have to take any kind of a treatment for this, because adding the figure of depreciation and deducting the capital expenditure will give you exact same, zero impact. That means no change will be there. So you can ignore this. Working capital is 44 lakhs. Okay. Now, if you, let me just take a couple of figures. Now, outstanding debt is 1934 lakhs. This is the debt. What they have done with the debt, I will show you. Acha, one more problem in the question is, this is free cash flow to firm or free cash flow to equity is not given. And they institute also has alternative answer for this question. So, if we assume this as firm's cash flow, as per the firm's cash flow, then the answer is like this. And you can assume that alternatively, following value, no. Answer as per equity cash flow approach. Now you tell me, how would you get to know about it in the exam? There is no proper way. So basically speaking, there are many mistakes. I will show you one. There is something that they have calculated which made the value of the share as 0 rupees. Minus, the share has a 0 value, hence overvalued. 0 value. Not at all possible, because the figures are not matching. They are not properly going according to the question. Frankly speaking, there are lots of mistakes in this question. Instead of wasting time in this, you can avoid it and skip. Because the concept that has been used in this question is the same that you have been looking for till now. I will just give you a summary of the concept. This is it. That's it. Value of the firm can be calculated using free cash flows to firm and cost of capital. But the main problem, the cash flow that was given in the question was not clear that whether it is free cash flow to firm or equity. So what do we calculate? This or this? Because once we assume it as this, then we have to deduct the value of the debt as well. So I'm just moving ahead of this question. Skipping it is the best thing that we can do right now. Okay, this is the question related to enterprise value. I think so. Yeah, EBITDA multiple is 5. Enterprise value. Do you remember what is the concept of enterprise value? I will show you. There is one thing called as enterprise value and the market value of the share. Market value of the share is very simple. Market price into number of share. So in order to buy a company, you have to buy all the shares of the company at the given market price. So let's say for example, 800 crore is the market value of the share. So if I want to, or let's say for example, Adani wants to buy a company, it has to pay 800 crore. But is that the real cost of acquisition? No, sir. That's not the only outflow Adani will have to make. If they are buying the company, that means they are also buying the liabilities of that company. So paying 800 crore to the equity shareholder is not enough. You have to make the payment to the debt holders also after making that 800 crore payment. So practically speaking, if the debt holders are 200 crore in the company, the total outflow for you is around 1000 crore. First pay to the equity shareholders, own the company, and since you own the company, you owe to the debtors also, so to the debt holders also. So again you will have to pay 200 crore. So real value is not presented. Real acquisition cost is not presented by the, we can say, market value. Acha, one more concept. If you buy this company of 800 crore and let's say the bank balance of this company is also 800, means this company has kept 800 crore rupees in their bank account. So virtually it will appear that your cost of acquisition is 800 crore, whereas you paid 800 crore and you got the bank balance of 800 crore. So practically speaking, it cost you 0. Let me explain this. Just a minute, huh? So this is a box, right? This is 50 rupee note. I just kept it in this. Now this is kept in the store and the price of this box is 50 rupees. So what will you say? How much this box is costing me? 50 rupees? No sir, not at all. I paid 50 rupees and I got this box in which again I found 50 rupees. So practically speaking, I paid nothing and I still own the box. So the cost was zero. So that's why ultimately what I want to say is market value or market price of the equity share does not represent the true cost of acquiring anything. And that is represented by the enterprise value, which is nothing but, let me just go through the chart if you will remember it. See, in security valuation we had discussed this. Enterprise value is equal to market value of the equity that we had just discussed, and after buying the company you will have to make the payment to the preference shares also, so add that. Debt holders also add that. Minority interest also add that. So you are adding all the other liabilities that you will have to make the payment for after buying the company, minus the cash balance that you are getting. Cash balance, investments, that's it. So this is going to be the enterprise value. This represents the true cost of acquisition. Now coming to the main part, that is the question. See, A Limited made a gross profit of 10 lakh and incurred indirect expenses of 4 lakh. So you can clearly see that 10 lakh is the profit, 4 lakh is the expense, so 6 lakhs is left. The number of issued equity share is 1 lakh. And the company has a debt of 3 lakhs. Debt 3 lakhs. Number of shares 1 lakh. Surplus fund is 5 lakh. The market related detail is like this: risk-free rate of return, market return, and the beta. With this, we can easily calculate the cost of the company, that is overall cost of capital, we can say, beta of the company. Now we have to find out per share earnings value of the company. So first of all, we will have to calculate the earnings. Based on the earnings, calculate the value of the company. And it's very easy. 10 minus 4, 6 lakhs. You calculate the capitalization rate. Earnings capitalization rate. Because it is earnings method, earning will be capitalized. We will calculate the value of the company. Divided by 1 lakh, you will get the per share value. See. 10 lakh minus 4 lakh, 6 lakhs, you divided the 6 lakhs with the cost of capital. So once you divided, you got the total earnings value of the company. That is somewhere around 553.33 lakhs in thousands. 53.33 lakhs divided by number of shares. So this is earnings value. It's very simple. This was a method of earnings capitalization method. You capitalize the earning, calculated the total value and divided it by the number of share to calculate the per share value. Now, what is the equity value of the company? Not the total. Equity value of the company if EBITDA multiple is 5. Now, 10 minus 4, 6 lakhs is nothing but the EBITDA itself, because no information of interest, tax, depreciation and amortization is given. So what will you assume? The gross profit minus indirect expenses. It's EBITDA itself. So EBITDA is 6 lakhs into 5. So that will be 30 lakhs. 30 lakhs is the enterprise value. EBITDA multiple 5. What is EBITDA? So it's very simple. EV by EBITDA. EBITDA. Okay. TDA is 5. So once you write down this as 6 lakhs multiplied by 5, you will get the enterprise value. And what is the definition of enterprise value, sir? Enterprise value is equal to equity value plus debt minus surplus funds, because nothing else is given. So 30 lakhs is the total enterprise value. 30 lakhs is equal to equity value plus debt of 3 lakhs and minus surplus funds of 5 lakhs. So you can do this calculation and arrive at the equity value. Have a look. EBITDA multiple, capitalized value is 30 lakhs. This is called as enterprise value. In enterprise value, you will deduct the debt. If you remember the formula, EV is equal to equity value plus debt value minus surplus fund. So 30 is equal to equity value plus debt is how much? 3 minus 5. So that's minus 2 go. Minus 2 which will go on that side will become plus 2. 32 lakhs is the equity value. This comes to 32. That's it. Simple question. It was from the study material. Now is the time for a new concept. We will take a break, and in the next lecture we are going to start with this new concept called as economic value added. We are going to discuss the concept first, and then we will start with the question number 28. See you.